Good morning. Welcome to Bazaar Morning Call. I'm Lata, with me Anuj and Sonia, and a very important day as the polls start, something we've been waiting for such a long time. And of course, today there are only 18 seats that will go to polls, and we will not know the result till December 11th, if I'm not mistaken. But nevertheless, the noise will be there, and that will be important for the markets. It's something that will cap both sides, I guess, both the top and the bottom. More immediately, Asia is starting a little tentatively, and that's telling us two things. One, that dollar index going to 97 is clearly indicating risk aversion, a worry of growth, which is why you normally go to dollar and to dollar-denominated bonds. So we should keep that in mind, that while that will be good in terms of weakening the rupee a bit, it is going to be a bit of a bother for equities. A second bother for us could be crude. I mean, at 71, it is still a very pleasing number. But, from 69.10, the low that it touched on Friday, it's crawled higher largely because the OPEC is clearly looking at production cuts. So perhaps the worst of the crude fall in this round is over. But at 71, we can still take it. I'm just putting that as one of those cues that the market will watch out for and maybe take some profit off oil marketing companies. We have to keep both these in mind.
Oh, yes, we have to. And that's, I think, the reason why the Dow fell on Friday as well, right? Worries about global growth slowdown, slowdown in China, trade tensions, etc. And we have the elections coming up. So perhaps it could be a bit tricky this week. It's the first full week post-Diwali as well. So let's see how it shapes up. Anuj, morning. You get a sense that, it's better to be a bit guarded this week, considering that you have so many potential negative cues?
Yes, morning, Sonia. And not just that, because we have outperformed quite a bit, over the last few days. If you just look at the internals, and one thing which I found out is, while there might be periodic bouts of underperformance and outperformance, our market tends to now, move in line with the emerging market. So if you see the MSCI Asia ex Japan and MSCI emerging market, they're up about 1.2 to 1.4%. MSCI India is up 4% this month. And year to date, that's led to this bit of a skew now, 14% down for emerging market and Asia ex Japan, and India is up about 12%. So perhaps time to be a bit cautious. Not a time to short the market yet, perhaps, but if you're, perhaps holding long positions since the last 300, 400 points, maybe you want to just trail your stop and see how the market moves. Also, there are other two factors. The Nifty has now retraced 33% of the decline from highs, and the mood in general has again become very bullish, with the mutual fund inflows, everyone, crude going down, everyone's now talking about the worst is well and truly over. So sometimes you just want to be a bit cautious. Also, we are very close to 200-day moving average. The Nifty is just within 150 points. The Bank Nifty is within 300 points. So if these levels are taken out, then the rally would be bigger. But if the market halts here, then there's a risk of going back to the previous low. So that's why perhaps time to be a bit cautious. The only good thing is that the mid-cap action has been looking very good, and that may continue to see more action if the markets do not fall at the index level. So perhaps you may want to play this market now, just stock specific. The big Nifty and Bank Nifty move perhaps could be now over, at least for the time being.
Okay. Well, actually, all the Nifty results are now in, with Titan also coming in. And now it is very clear that the second quarter has been more or less a washout. It's a flat quarter in terms of earnings growth. First quarter, we did very well, 15 to 16%. So now if, that I'm just reading out the CLSA note, now getting to that 580 EPS for the Nifty this year looks pretty nigh impossible. And CLSA probably is doing something which others will do. They have dragged down their earnings growth to about 10%, which is a bit of a shocker. More people are still now at 14 and 15. But it does look like it's going to be a very big ask now in the second half to be able to make up for the loss in the second quarter. SBI is a big culprit, but nevertheless, the point is now, even if we get a lot of good news in terms of crude and in terms of, flows, the worry will be that our earnings is not what it was. So, and now to expect a valuation uptick also is difficult. This earnings number is not looking very encouraging. I mean, going down to 10%, 10.5%, I think CLSA is a bit of a shocker.
Oh, absolutely. And today also is a big day of earnings. I mean, you have the likes of Aurobindo, Britannia, Eicher Motors, Jet Airways, and you could get more misses than hits in today's numbers as well.
Yes.
Yeah, with Eicher, Jet, etc. So we'll keep tracking all of that for you. But let's take a quick look at what our wise experts have to say as we head into trade this Monday morning. Mahesh Nandurkar of CLSA says the Q2 results season has seen the largest earnings cuts in the last 11 11 quarters. CLSA analysts have cut the March 2019 Nifty EPS estimates by 5.5%. Large downward revisions were seen in the cement companies, in Tata Motors, IndusInd Bank, Cipla and Vedanta. CLSA now forecasts just a 10.5% Nifty EPS growth in FY19 and a stronger 26% growth in FY20. Mahesh adds that India model portfolio, they have added ICICI Bank and reduced the weight on ICICI Pru Life as well as IndusInd Bank. CLSA has also removed Cipla and Jubilant Foods and instead added weight to NTPC and introduced ONGC in their list.
Whenever you add NTPC, you're quite clearly becoming defensive. Yeah. So there you are. That's the CLSA view. Let's get you money market views. This one is from B. Prasanna, the head of Treasury at ICICI Bank. Prasanna says a sharp fall in oil prices and positive fund flows from FIIs in both bond and equity markets have changed the market sentiment and demand-supply dynamics in favour of Indian rupee. However, he says broad dollar strength against major currencies, post-hawkish Fed statements and yesterday's OPEC intentions to cut oil supply by around 1 million barrels per day in 2019 is likely to cap further appreciation bias for the rupee in the near term. He expects the rupee to trade in the range of 72.35, 72.95 for this week.
Okay, he also talks about the bond market. He says the confluence of positive factors is bringing stability to the bond market amidst falling crude prices, softening bias in consumer prices, and the RBI liquidity infusion through the open market operation route. He says investors' preference away from spread assets to sovereign and gradual return of FII money are additional supportive factors for the bond market flows. He adds, though the uptick in crude due to OPEC statements will lead to a weak opening today, the general positive bias in GSEC markets is likely to continue for the week. He expects the 10-year benchmark bond yield to trade in a range of 7.72 to 7.82%.
Okay, let's talk about the global cues. Here's Mangalam with the world view.
Well, growing concerns over global growth slowing is what took the Wall Street lower on Friday's trading session. So we had the Dow lower by about 200 points, about a percent shaved off S&P 500 and 1.7 off the Nasdaq as well. So the stocks which lost were the key economy-facing stocks. We had Caterpillar as well as General Motors and Goldman Sachs falling down, and the Nasdaq was an underperformer primarily on account of all the FANG stocks which ended lower on Friday's trading session. However, across the Atlantic, the European markets reacted on Friday to the decision that came in from the Fed post the European market close on Thursday. However, the sentiment out there was also impacted by commentary coming in from the Italian finance minister, who said that there is no intention of plowing back the 2019 spending plan. So that index was lower by about 0.9% as well. But the Asian markets, they're by and large in the green. However, shuffling between red and green, the Korean index is the only one which is underperforming. The SGX Nifty indicates a tepid start to trade, and that's primarily because the key monitorable remains crude, which is back above that $70 per barrel mark after reports that the OPEC and other countries, including Russia, may soon cut output.
All right, Mangalam, thanks a lot for that. So there you have it, 11 straight days of a fall seen in crude coming in at a 9-month low. That continues to be a positive, but of course, it also indicates a slowdown in growth. But let's get some more views then, some macro views. Ashmore's Ashwini Agarwal spoke to us earlier, and he said the current market sentiment remains quite upbeat due to the fall in crude prices. He also added that the earnings story is not looking very good at the moment. Listen in.
If you look at the narrative a month ago and you look at the narrative today, the single biggest change is the crude oil price. And this is the biggest pivot for India. The crude oil is down by about 20%. That fixes a lot of things. I mean, it gives you essentially about $20 billion on the current account balance as a delta, which is fairly large. Yeah. So, you know, sentiments are up. Aggregate Nifty valuations are still not in a mouth-watering territory. They're probably at a 10-year average or a 15-year average, but they're not at -1 standard deviation where you can, you know, thump the table and say that, look, the bottom is behind us. So valuation-wise, things are still not inexpensive. And the earnings story isn't looking good. I mean, if you look at the current earnings season, revenues are up 20%, EBITDA is up 10, 11%, but earnings aren't up. A lot of this is because of FX volatility, raw material price pressures, and so on and so forth. But it's not a simple story. The earnings growth story is still not panning out. So to expect a significant upside in the market on the Nifty in the short run is difficult. when I look at individual companies in the smaller cap space, I find a lot of value. I mean, there are stocks which on a historical basis are trading at -1 standard deviation on a price to earnings basis or on a price to book basis. We put on a position in one of the NBFCs, and, you know, my colleagues and we looked at it every which way, and we felt that we had a downside protection. We obviously didn't think that we'd make 20–30% in a span of 3 weeks, but that's the kind of valuation support that you're looking for. And that valuation support is emerging in a lot of smaller companies. So, you know, when you go stock specific into the smaller market cap space, you find a lot of valuation support.
Okay, so that's Ashmore talking about the fall in crude prices. That's a positive. But of course, the earnings growth has also slowed down. So that continues to be a spot of bother for us. Let's take a quick break on that note. On the other side, our list of top 10 stocks lined up. Do stay tuned in.